Hello, Sector Watchers. Welcome to the show. This is the 65th episode of Sector Spotlight for Tuesday, the 2nd of February, recording it on Monday the 1st. My name is Julius de Kempenaer, and I'm your host for today's show, presenting from Amsterdam in the Netherlands, where it actually started freezing this weekend. Believe it or not, the first people were skating on natural ice. That has been a while. Anyway, if you'd like to stay in touch with me, share anything with me, let me know anything, have a discussion, please use any of the handles that you see on the screen right now. You can also send me an email, and there is a big chance, I usually answer all my emails, maybe not the next day, but I try to keep up with that. So please feel free to share any information, comments, feedback that you have on the show. It'll give me a good idea on what you guys want to hear from me going forward, and I can answer any of your questions. Today is the first Tuesday of February, and that means, as usual, that we're going to look at the completed monthly bars for January. That'll be a pretty big part of the show, and I will try to bring in the weekly RRGs for asset classes, for sectors, maybe some fixed income stuff, depends a little bit on how fast we go, and rebuild the investment pyramid that regular users of the show probably have seen before. I expect that to take up the better part of 30 minutes, so it'll be pretty much all markets that we're going to be discussing. But before we start doing that, we're going to look at what happened last week through the lens of relative rotation graphs. Let's start with the rotation and the performance of asset classes last week. RRG on the left-hand side of the screen, and on the top of the list, both commodity ETFs, the Bloomberg Commodity Index and the S&P GSCI Commodity ETF, both a little bit over 1% higher, losing relative strength versus VBINX over the last 5 days. Just like the stock market, ITOT. ITOT at the bottom of the list this week, minus 3.4%. Obviously, the last few days of last week, Wednesday, Thursday, Friday, pretty weak days for the stock market, down somewhere between 1.5% and over 2%. And you see that move down in relative momentum, that tail that was coming down that we saw already previous week is now accelerating lower. So if we scroll back 1, 2, 3, 4, 5, this was prior Friday, and this is what happened during the week. So we see that rolling over pattern that we saw in the stock market has continued and is now moving deeper into the weakening quadrant, resulting in a minus 3.4% for stocks. Still on the right-hand side of the RRG, nevertheless in weakening and losing relative momentum, and we see the fixed income cluster, government bonds, corporate bonds, high yield bonds, and the US dollar inside improving and picking up that strength that was left on the table by the stock market. Maybe a little bit of an outlier for real estate, doing really, really well, relatively well, I should say, because real estate still lost 90 basis points, but this is a good example of how something that loses money, or an asset that loses money but loses less than the benchmark, can still end up in the leading quadrant. So no massive shifts, I'd say. Stock market we need to keep an eye on. We're going to dive into that much deeper when we cover the monthly charts and the weekly RRGs. But this is what happened on the asset class front. If we now move over to the right-hand side of the graph, where we have the sectors, then we see a lot of red, actually. As a matter of fact, it's all red. Not one sector recorded a positive return last week. SPY was down 3.3%. And if we look at the sectors that did well and not so well, we see that the defensive stuff, not surprisingly, comes out on top. Real estate, 20 bips lower, and then utilities, staples, healthcare, all 1.1, 1.5, 2.2. Now we get to communication services and technology. They lost 2.8 and 2.9%, but that is still better than the overall loss of SPY, which was 3.3%. And then everything that's below that white line here was underperforming over those 5 days ending January 29. That was last Friday. So we got industrials, financials, discretionary, materials, energy. Energy losing a lot. That's a very volatile sector at the moment. Some weeks it's up 5%, and now we have a week where it's down 6.5%. I'm going to prepare you. I find that a very difficult sector to keep to analyze, to keep an eye on, to know what's going on. It's not super clear in my opinion. But we have to deal with it, and that's also a market that we need to keep an eye on and take a look at. If we look at the rotation over those 5 days, then you can see where that strength and weakness is coming from. So we go back 1, 2, 3, 4, 5. We're now on Friday, and then you see that real energy was already coming down. It already hooked over. You saw that financials, materials were already nose diving down into the weakening quadrant. And basically those trends were extended into last week, Monday, Tuesday, Wednesday, Thursday, and Friday. So you see that rotation, and you see that this cluster here of more or less defensive, and you can see that technology picked up. It's, we've written about it, the new defensive sector been starting to pick up again. I'm going to leave it at this for the weekly overview, and we're going to shift to our monthly charts and try to combine that with some weekly RRGs and some technical stuff. Let's start our monthly helicopter view using monthly charts with the stock market, with the S&P 500 or SPY. And remember that last bar that you're watching here, that is, let's say, half to 3/4 or the day's trade of Monday, the 1st of February. So we're going to concentrate on the one to last bar, which is the completed bar of January. And as you can see, on a monthly basis, and if you just look at the highs and the lows of the bars vis-a-vis each other, then again in January, SPY made a higher high and a higher low. So the high was higher than the previous month and the low was higher than the previous month. We did reverse during the month. We opened a little bit higher than we closed in December, and then we rallied and we closed, well, not at the low, but in the lower half of that range. So not a particularly strong bar for the month of January, but not super weak either. So the uptrend, the long-term uptrend, as we're watching it here since 2009 going higher, and if you want to take a little bit shorter term view from, let's say, February 2020 higher, that is all still intact. So a couple of, down days, weaker days, is not going to hurt this really long-term uptrend in stocks. What is your risk? Of course, if the market goes higher and higher, the risk is increasing. And if I look at this chart right now, I think that a level to keep an eye on is the high of August, which was, let's round it off at 360. And probably the rising parallel here. So we've got, this is the big red is my, big support line going higher. Obviously that's, way down. And then we have this parallel here that, try to run through as many touch points as possible. So we got 1, 2 here, depends a little bit on how you count. We hovered above it, came back below, but you see how many of these lows were touching that line, and then we're touching it here as resistance, hovered around it here, we have it as support, we break it, have it as support, we break it, and now, so it's apparently a line that the market wants to respect. And a new one seems to be building here. It's already 3 years old. And that's right now running around 340, where it meets the high of February, which was also around 340. So despite the fact that the market is in an uptrend, we definitely have to, take into account, be aware of the fact that downside risk is increasing the higher the market comes. What are the risks? As I said, the first one that I'm watching here is 360 and then is 340. But even when that happens, I don't think the long-term uptrend will be damaged anytime soon. If we go to the government bond counterpart, and here is GOV, that's the whole curve. We've seen this before. I think that this is a completed double top, and we'll continue to see higher yields. In terms of GOV ETF, the price could go down to 26.60. If we translate that to IEF, which is the 10-year bond, we see that it's following a similar pattern, slightly lower. GOV already completed that double top a couple months earlier, and now it happened in January with IEF as well. What is the target? I would say around 114. That means that there is plenty of downside for bond prices, which means plenty of upside for yields, 10-year yields. And we'll see that when we watch the yield curve chart, the spread between the two. Quickly move on to corporate bonds. That's LQD. Not broken out yet, not completed that double top, so it's slightly better than government bonds, but it ran into trouble, and we're now moving sort of sideways. And if we quickly shift to high yield, then that is still in that trading range, that long trading range that we've been monitoring for, I don't know, as long as Sector Spotlight is alive, I would say. Don't be fooled, this is the unadjusted chart for high yield. If we bring into account the dividends or the coupons that are paid by these high yield bonds, you obviously see a completely different chart. So it's definitely an interesting asset class. But in terms of support and resistance, I prefer to work with the unadjusted version, which shows me that it is in a trading range. If we go to real estate, still in that trading range. We tried it at the start of 2020, dropped back, and we're now struggling with that line around $85 US, $86 US, where the market so far has continuously been pushed back down. So from a relative point of view, V&Q is still lagging. Stocks, it's keeping up right now. So we'll look at the RRG later on and see if the fact that V&Q real estate is now able to hold up around current levels while stocks are going down shows an improvement of relative strength for this asset class. And then the maybe this most surprising asset class, and we touched upon it last week already, that is commodities. And we see the DJP ETF, the Bloomberg Commodity Index ETF, breaking a long-term resistance line. It looks as if it's now starting to challenge this overhead resistance level here around 23, slightly above 23. This I think could be the next really important asset class. It's very early stages, despite the fact that we've got a massive run up from the lows on. But if you compare it with the decline that we've seen, it's only just beginning. So don't be fooled by the amount or the percentage gain that we've already traveled since early 2020. I think we will see some form of a correction going forward, but it will be very important to note where a potential new low, major new low, will be put into place. And when that happens at levels, let's roughly say above, like this red line here, which is just below the around 19. When we put in a new low above 19, preferably above this dotted old resistance now support line, commodities are getting more and more interesting as an asset class, I think. And we'll see a quite similar pattern with GSG. A little bit more trouble with long-term overhead resistance, but look at the massive decline that this market has gone through. And sorry, you see that what we see here is just the initial start of a potential new uptrend. DJP is a little bit further in time than GSG, but I think that we definitely need to keep an eye on commodities as an asset class going forward. Let's quickly look at the US dollar. Interesting. I think the weakness for the US dollar is still there. This long-term trend, this trend line has been broken. I'm watching 88 in the dollar index. And if we translate that to euro dollar, I'm watching 125. Declines so far are declines within a new uptrend that started early 2020 and watching 125 on the upside. We go to the relationship between stocks and bonds. That is still clearly in favor of stocks over bonds. There's no surprise there. And here is the chart of the yield curve, 10 minus 2-year yields in combination with the S&P 500. And we see a rapidly accelerating yield curve. So it's a rapid steepening of the yield curve. And I've discussed this before. I'm still trying to figure out whether this decline that we had early Feb 2020 was the decline that you often see at the start when there is a reversal, or are we in for more downside? So this is my sort of red flag warning. It's the only one in all the charts that I'm looking at that could call for a more serious correction. But I don't see any of that yet in the price chart. So I'm keeping this in the back of my mind as a warning signal. And that was it for the monthly charts. Let me quickly try to bring you up to speed with my investment pyramid in combination with some price charts. I'm not going to do all of them. I'm going to keep real estate, government bonds, high yield. They're all on the left-hand side. So these are my underweights. Stocks or SPY is still, and I'm going to switch that to my chart list for Sector Spotlight because these are the weekly charts. And where is my SPY? So here is the stock market, as I said, and here we see a little bit more granular details of that uptrend, and we bounced the month. So this is the weekly bar, bounced at support of that rising trend channel. We're still struggling with overhead resistance in terms of relative strength, but the RRG lines are stable, which still warrants an overweight position for stocks versus bonds, I think, in an asset allocation model. Underweight US dollars, underweight these three commodities, shifting to an overweight. Maybe a little bit late, but better late than never, I think. We should have probably paid a little bit more attention, and then we would have been able to pick up this move a little bit better. In the end of the day, the RRG lines moved into the leading quadrant already in August 2020. Sort of blinded by the long-term downtrend, I guess. I don't know. A little bit of a rotation through weakening and now back up for the second leg up. And that's the one that we're watching here right now. Overhead resistance around 450 in GNX. It's the commodity index. If we look at DJP, that's the ETF, you see that it's pushing against overhead resistance. And again, this also moved into the leading quadrant in September 2020. And it's now coming out of that weakening and pushing it into leading. So commodities definitely deserve a little bit of allocation at an asset allocation level. And then corporate bonds continue to be at an underweight position. This is the top line of the asset classes and the asset allocation. We're going to take a quick break for 30 seconds. And after that, we're going to continue to work our way down in this investment pyramid. Let's have a quick look at the monthly bars for the various sectors, starting with materials, XLB. You can see the month of January pushed it to a really much higher high and then reversed. So The price development during the month was not too strong for the materials sector. However, that trend is still very much upward pointing. The risk is quite large towards pretty much 60 US dollars. So despite the fact that the trend is still there, there's definitely quite a fair amount of risk inside the materials sector in the near term. If we move to communication services, here also a new higher high but a lower close and actually a lower low than the previous month. So the bar for January actually completely encapsulates the bar for December. Usually that's not too good of a sign, but the case with communication services is that it just broke out and the low of January actually held at the high of September. So that higher high, higher low rhythm is still there. That uptrend is still there. We go to energy. We see here, here's my trouble, as I told you in the beginning, my problem with the energy sector. The swings are so big and there's not a real trend visible. So despite the fact that these trends are dozens of percentages, from 22.50 to 45 and then back to 27.5, all the way back to 45. Those are massive swings in terms of percentages. But if you look on a trend basis, the only thing that we conclude here is that this downtrend sort of ended and we're now in a sideways move, sideways pattern, and whether that's going to be a sideways bottom formation or a sideways continuation for a move further down on the long term, there's no way we can tell. That makes it one of the more difficult charts to analyze in the sector universe. We go to financials, we see that 31 was respected as resistance, seriously respected, I should say, because we actually closed the month of January pretty much at the low of the month. We're inside the channel. Again, there's no real uptrend visible. We should break above 31, above this overhead resistance level to actually make that happen. It's not a bad sector either, but there are better sectors in the universe than just financials. We look at industrials, one of the sectors that broke out, and we have this reversal bar encompassing the month of January, higher high, lower low, with a low below the low. Usually not too good. But here also, just like communication services, we're holding up above that previous high, and that is pretty good for this sector. That still makes it an interesting sector from a longer term point of view. We go to technology. This is a good sector. It broke out to new highs. No real reversal bar, higher high, higher low for the month. Looking all good, picking up new strength within the already existing uptrend. We look at consumer staples, broke out of the rising channel and is now testing that that old resistance line as support. If and when consumer staples really drops back into that channel, and let's say with prices around 62.5 or below 62.5, then I think that consumer staples is really at risk for a renewed test of the lower boundary of that channel. That's a serious decline. I'm going to keep an eye on that for the staples sector. And then we have real estate, holding up there at the top of the range, but still in the range that started at, second quarter of 2020, between, let's say, 33.50 and almost 38. We're still there. If we break out of that range, maybe a little bit more upside, but for the time being, real estate, a sort of neutral sideways trading sector. And then we have utilities inside the channel, just minding its own business, not very strong with the market rising. This rally, this trend is not strong enough to position utilities in a relative uptrend, so it's inside the weakening quadrant, just because it's lagging the strength of the general market. And then healthcare, that's an interesting sector because that one actually broke out and it actually closed at a new all-time high. So this is the sector that didn't do much. It moved nicely up, but there were other sectors that were doing much better. And here we see that in January, a lot of sectors came off, leveled off, started to come down. Healthcare actually came down a little bit, but it closed at an all-time high. That is a very strong sign. We're going to look at that a little bit closer because I think healthcare is going to be your stealth sector. That's your stealth trend underway. And then finally, to wrap up this monthly piece with the sectors, we look at the consumer discretionary sector. And here also we see a big month, a long-range month, but with a higher high and a higher low and a new all-time high close. And the close was actually above the close of January, and that's a good thing. And that trend is still intact. We're going to take a quick look at how that all fits in with our pyramid and with the building up the investment pyramid and the weekly RRGs. I have only a few minutes left, so I'm going to take a shortcut and jump all the way down to the bottom of the pyramid, looking at the sectors. And I will write up what I wanted to say about the other parts of the pyramid in a blog article, very likely tomorrow, maybe even before you watch this show. Let's look at how we are positioned in sectors. This one was already old, so the changes may seem quite large, but I hope that if you're a regular watcher of the show, you picked up some changes that we made suddenly while we were discussing the rotations of these sectors. Materials, I'm going to keep at an outperform recommendation because it's still the third highest ranking sector on the RS ratio, and the long-term chart is still good. Communication services went through a very nice rotation, but is now losing strength and heading towards the lagging quadrant. So I'm going to bring that to a neutral, and we actually, it has a red boundary because that was in October, but we've been pretty bullish on communication services going into December, January, etc. So that's where it's actually coming from. And the same goes for energy, and the same goes for financials. Industrials is still neutral. Maybe missed a little bit of the upside there. Technology, no doubt about it, was an outperformer, is still an outperformer, and you see that it is now rotating into the leading quadrant again. This is including today's price move upward, so that's going in the right direction. Staples, real estate, utilities, all very clearly underperformers. They're inside lagging and all underperforming the benchmark, with real estate curling up a little bit, but you know it's a short tail at the left-hand side of the chart at very low levels. That's an underperformer. I'm going to jump to consumer discretionary as it is rotating back up, and it was at an outperformer. It's still an outperformer, and I still think that's a sector that you should have in your portfolio. The one that I want to point your attention to now is healthcare. If you look at the healthcare sector, it's inside improving, but it's starting to move to the right. It's starting to pick up relative strength. I think this is a stealth rotation. This is picking up strength where maybe people are going to miss it. Why? Because it was in a long-term downtrend, but it's holding up at the bottom of that range and starting to pick up relative strength. And the series of higher highs and higher lows is very clearly intact. Guys, I think that the healthcare sector is the one that you need to keep an eye on in the coming weeks, because this could be the surprising sector. We need to wrap it up. This was Sector Spotlight. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Please stay safe, and I hope to see you all back next week on Tuesday with Sector Spotlight. Thanks for watching.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.